For most people, price is the market. If prices are rising, things are good. If prices are falling, something is wrong. This belief is deeply ingrained. It feels intuitive. It feels obvious. But it is also increasingly misleading because price is no longer the primary signal markets respond to. In modern financial systems, price is often the last thing to move, not the first. For decades, price discovery was the mechanism through which markets processed information. Buyers and sellers expressed expectations through transactions. Supply met demand. Risk was negotiated in real time. Price reflected tension. That world no longer exists in the same way. Today, price is increasingly a byproduct of structure rather than an expression of judgment. Markets have not become irrational. They have become automated, constrained, and conditional. And that changes what price actually means. To understand why price is losing its signaling power, it is necessary to understand how modern markets are constructed. Most market participants no longer trade based on valuation alone. They trade based on rules, systematic strategies, volatility targeting, risk parity, passive index allocation, derivative hedging flows. These systems do not ask whether an asset is cheap or expensive. They ask whether exposure fits within a predefined framework. When volatility rises, exposure is reduced. When volatility falls, exposure increases. When correlations shift, portfolios rebalance. Price does not lead these decisions. It reacts to them. This is a fundamental inversion. In earlier market structures, price was the signal that caused behavior. Now, behavior causes price. This difference is subtle but critical because when price is no longer the signal, markets can move in ways that appear disconnected from fundamentals, sentiment, or news. Prices can remain elevated while risk builds. Prices can remain stable while liquidity disappears. Prices can collapse without obvious catalysts, not because markets are broken, but because the signal is no longer where people are looking. Another reason price has lost its signaling power is liquidity structure. Liquidity today is not continuous. It is conditional. During calm periods, liquidity appears abundant. Spreads are tight, depth looks sufficient, execution is smooth. But this liquidity exists only under specific conditions: low volatility, predictable flows, stable correlations. When those conditions change, liquidity does not gradually decline. It withdraws. Market makers reduce size. Algorithms widen spreads. Balance sheets contract. This withdrawal happens before price reacts. By the time price moves meaningfully, liquidity has already thinned. This creates a dangerous illusion. Observers see price stability and assume resilience. In reality, resilience has already eroded. Price becomes the lagging indicator. Another factor undermining price as a signal is the dominance of derivatives. In modern markets, a significant portion of exposure is expressed through options, futures, and swaps. These instruments allow participants to gain or hedge exposure without transacting in the underlying asset. This shifts where price pressure originates. When options positions become large, hedging flows can dominate price movement. Market makers adjust delta exposure mechanically. Gamma effects accelerate movement. In these situations, price moves not because investors are changing their views, but because hedging requirements demand it. This means price can rise without conviction and fall without fear. The signal is mechanical, not psychological. Another structural shift lies in passive investment. Index-based investing does not evaluate price. It follows allocation rules. Capital flows into assets because they are included in an index, not because they are attractive. As prices rise, index weights increase. As index weights increase, capital flows increase. This reinforces trends. During these phases, price appears to validate itself. But this validation is circular. Price rises because flows follow price. Flows follow price because price rose. There is no independent signal. When this process reverses, it does so abruptly. Passive flows do not step in to stabilize markets. They respond after price has moved. This creates asymmetry. Upside is gradual. Downside is sudden. Price no longer warns. It reacts. Another reason price has become unreliable is leverage. Leverage amplifies outcomes, but it also distorts signals. When leverage is cheap and abundant, price becomes insensitive to risk. Positions can be maintained despite adverse information. Losses can be financed. Drawdowns can be absorbed. This suppresses volatility. But suppressed volatility does not mean suppressed risk. It means risk is accumulating invisibly. When leverage constraints tighten, price reacts violently, not because information changed, but because financing conditions did. This is why price often moves after funding conditions deteriorate. Funding is the signal. Price is the consequence. Most people do not watch funding markets closely. They watch charts. By the time charts react, structure has already shifted. Another reason price has lost signaling power is policy intervention. For years, markets operated under the assumption that severe price declines would trigger policy response. This belief changed behavior. Downside was hedged less. Risk was priced lower. Volatility was sold. Price declines were seen as temporary disturbances rather than warnings. This conditioned participants to ignore price signals. But policy capacity is now constrained. Rates cannot be cut indefinitely. Balance sheets cannot expand without consequence. Inflation limits intervention. Markets are adjusting to this reality, but price still reflects the old assumption. This creates misalignment. Price suggests stability. Structure suggests fragility. When these diverge, price eventually realigns, but not smoothly. Another structural distortion comes from speed. Modern markets operate at machine speed. Decisions are executed automatically. Risk is adjusted instantaneously. Feedback loops activate without delay. Price movement becomes discontinuous. There is little warning, little negotiation. When thresholds are crossed, systems respond immediately. Price jumps rather than trends. This makes traditional technical signals unreliable. Breakdowns occur without gradual deterioration. Reversals happen without accumulation. Phases. Price no longer communicates. It reacts. This leads to widespread confusion. Participants search for explanations in news. They attribute moves to headlines. They look for narratives. But narratives follow price. They do not cause it. The real drivers sit beneath the surface. Liquidity, leverage, structure, constraints. When these shift, price adjusts regardless of narrative. This is why markets today feel unpredictable, not because they are random, but because observers are watching the wrong signal. Price is no longer the messenger, it is the echo. Understanding this changes how risk should be interpreted. It means calm prices are not reassuring. It means volatility spikes are not anomalies. It means sudden moves are not surprises. They are structural releases. Markets are not telling stories through price anymore. They are expressing constraints. And constraints do not negotiate. They enforce adjustment. This is why the current environment feels unstable, even without dramatic crashes. The system is adjusting beneath the surface. Price will eventually reflect that adjustment. But by the time it does, the opportunity to prepare has passed. This is the danger of relying on price as a signal. It arrives too late. Under the surface of modern markets, signals no longer travel the way they used to. In earlier cycles, price served as a feedback mechanism. Rising prices attracted sellers. Falling prices attracted buyers. This interaction slowed extremes and revealed stress early, that balancing function has weakened. Today, many of the largest participants are not reacting to price in a discretionary way. They are responding to constraints, capital requirements, risk limits, margin rules, volatility thresholds. These constraints activate automatically. When volatility rises above a certain level, exposure is reduced regardless of price. When correlations increase, diversification assumptions break, forcing rebalancing. When funding costs rise, leverage must be cut, even if price has not moved. In these situations, price is irrelevant. The decision to sell is not based on valuation or outlook. It is based on necessity. This is why markets often appear calm until they suddenly are not. The stress is not visible in price because it is building elsewhere. One of the most important of these hidden pressures is funding. Funding conditions dictate how much risk the system can carry. When funding is cheap and available, risk expands naturally, positions grow, leverage increases, duration extends. As long as funding remains stable, price can drift higher with minimal resistance. But funding does not deteriorate smoothly. It tightens discreetly. Haircuts increase, margins rise, lending terms change, collateral requirements adjust. These shifts occur quietly, often without headlines, but they force behavior changes immediately. Participants must reduce exposure not because price is falling, but because financing no longer supports existing positions. This is where the illusion of price stability becomes dangerous. Observers see flat or rising prices and assume conditions are healthy. In reality, the system is already under pressure. The adjustment is happening through position sizing, not through price discovery. Another invisible constraint is balance sheet capacity. Market. Makers and intermediaries do not provide unlimited liquidity. They allocate balance sheet based on risk-return trade-offs. When volatility rises or uncertainty increases, balance sheet is rationed. This reduces depth. Trades that would previously move price marginally now move it significantly. But this reduced depth is not obvious until price moves. Again, the signal arrives late. Derivatives markets amplify this effect. When large option positions exist, hedging flows can overwhelm organic trading. If dealers are short gamma, rising prices force them to buy more. Falling prices force them to sell more. This creates acceleration. Price movement feeds on itself. But the origin of the move is not sentiment. It is positioning. This is why price can suddenly gap without news. The market is not reacting to information. It is unwinding structure. Another factor is correlation. During calm periods, correlations remain low. Assets appear diversified. Risk seems spread out. But in stressed environments, correlations rise. Assets that behaved independently begin moving together. This breaks portfolio assumptions. Risk models adjust. Exposure is reduced across multiple assets simultaneously. This selling is not price sensitive. It is systemic. Once again, price is not the signal. Correlation is. By the time price reflects correlation breakdowns, portfolios have already been forced to adjust. Passive strategies add another layer. Index flows do not discriminate based on conditions. They follow allocations. During inflows, assets are supported regardless of valuation. During outflows, assets are sold regardless of fundamentals. This creates delayed reactions. Stress builds beneath the surface as fundamentals diverge from price. But price does not adjust until flows reverse. When they do, the move is fast, because there is no discretionary buffer. Another structural shift is the disappearance of marginal buyers. In earlier cycles, value-oriented participants stepped in during declines. They absorbed supply. Today, many of those participants are sidelined. Valuation matters less when policy-dominated returns. Structural flows matter more. This reduces natural stabilization. When selling begins, there are fewer buyers willing or able to absorb it. This is why declines feel sharper, even without panic. The system has less elasticity. Another reason price has lost its signaling power is time horizon mismatch. Algorithms operate in milliseconds. Funds rebalance daily or weekly. Policy reacts monthly or quarterly. These layers interact unevenly. Fast-moving systems respond before slow-moving ones can adapt. This creates overshoot. Price moves beyond what fundamentals justify before stabilizing forces arrive. This overshoot is often mistaken for irrationality. It is not irrational. It is structural. The system is responding at different speeds. Traditional analysis assumes price integrates information gradually. Modern structure violates that assumption. Information does not flow smoothly through price. It is filtered through constraints. This fundamentally changes how risk should be interpreted. When price no longer reflects early stress, relying on it becomes dangerous. Calm markets may be the most fragile. Stable prices may mask tightening conditions. Low volatility may indicate complacency, not safety. This is why late cycle environments are so deceptive. Everything appears functional until it doesn't. The failure does not begin with price. It begins with constraint. Funding tightens. Liquidity thins. Correlation rises. Leverage becomes unstable. Price reacts only after these forces reach critical levels. This is not a flaw of markets. It is the consequence of optimization. Systems optimized for efficiency lose resilience. Resilience requires slack. Slack has been engineered out. The result is a market where price is no longer a warning system. It is a confirmation. And confirmation arrives too late. Understanding this requires abandoning old heuristics. Watching charts is not enough. Following headlines is not enough. The real signals operate beneath visibility. They operate through mechanics, not narratives. This is why markets today feel disconnected from intuition. Not because intuition is wrong, but because the system no longer communicates through price first. It communicates through pressure, and pressure accumulates silently. Pressure does not appear everywhere at once. It concentrates first where assumptions were strongest. And in this cycle, the strongest assumptions were built around liquidity, leverage, and continuity. For years, markets operated under the belief that funding would remain cheap, refinancing would remain easy, and exit would always be available. Those beliefs shaped where capital flowed, not into resilience, not into flexibility, into efficiency. Efficiency looks intelligent in stable environments. It maximizes returns. It minimizes friction. It removes redundancy. But efficiency is fragile because it assumes conditions will persist. The first areas where pressure becomes visible are not always the most obvious. It is not equity indexes collapsing. It is not dramatic headlines. It is not mass panic. It is subtle strain in the places most people do not watch. Funding markets, balance sheet margins, collateral quality, liquidity depth. These are not emotional systems. They are mechanical. They respond to cost, not confidence. When rates rise, funding costs increase. When volatility rises, margin requirements increase. When uncertainty rises, haircuts increase. None of this requires fear. It requires adjustment. The first place this adjustment appears is leverage-dependent structures, strategies that rely on continuous refinancing, positions that assume tight spreads, trades that only work when volatility stays compressed. For a long time, these structures dominated. Returns, carry trades, relative value strategies, systematic volatility selling, duration-heavy positioning. They worked because the environment rewarded them, but environments change. And when they do, leverage becomes a liability, not because it was excessive, but because it was optimized for the wrong regime. As funding costs rise and liquidity becomes selective, leverage strategies must adapt. They reduce position size, they shorten duration, they increase cash buffers. This happens quietly. No announcement, no crisis. But the effect is cumulative. Each reduction removes marginal demand. Each adjustment reduces liquidity. Each exit makes the next exit harder. This is how pressure spreads. Another area where strain appears early is in collateral chains. Modern markets are built on collateral. Assets are pledged, rehypothecated, used to support leverage elsewhere. When asset prices rise and volatility is low, collateral appears abundant. When conditions tighten, collateral quality matters. Not all collateral is equal. Some assets remain acceptable under stress. Others do not. As volatility rises and risk tolerance falls, the range of acceptable collateral narrows. This forces repricing. Assets that were previously interchangeable are no longer treated the same. Liquidity becomes tiered. This is critical because markets often assume liquidity is binary, either present or absent. In reality, liquidity becomes selective long before it disappears. This selectivity is destabilizing. It creates winners and losers, not based on fundamentals, but on structure. Assets with strong balance sheets, deep markets, and policy support retain liquidity. Others lose it. This divergence is often misinterpreted. People assume it reflects strength. In reality, it reflects access. Access to funding, access to collateral acceptance, access to liquidity providers. This creates feedback loops. Assets that retain liquidity attract capital. Assets that lose liquidity see outflows. The divergence accelerates. This is not a crash. It is a sorting mechanism. Another pressure point is duration. For years, duration was rewarded. Low rates meant future cash flows were highly valued. Long duration assets performed well. Risk models favored them, but duration is sensitive. Small changes in rates create large changes in valuation. As rates rise and remain elevated, long duration assets become unstable, not because they are bad assets, but because the discount rate changed. Markets struggle with this because duration exposure is embedded everywhere: equities, credit, real estate, infrastructure, private markets. This exposure cannot be unwound quickly. Private markets are illiquid. Valuations adjust slowly. Marks lag reality. This creates tension. Public markets reprice first. Private markets resist. Capital becomes trapped. This does not create panic. It creates stagnation. Deal activity slows. Exits disappear. Capital waits. This waiting is another form of pressure. It ties up liquidity. It reduces flexibility. It increases vulnerability to shocks. Another area where adjustment appears early is in volatility behavior. Volatility does not need to spike to signal stress. It only needs to change character. In stable environments, volatility is reactive. It responds to news. It mean reverts quickly. In adjustment environments, volatility becomes structural. It persists. It clusters. It reacts to flow rather than information. This changes how markets behave. Price moves become less informative. Liquidity becomes thinner. Slippage increases. Participants feel this. They may not articulate it, but they adjust. They trade less. They demand higher returns. They reduce exposure. These small decisions aggregate. The market becomes more fragile. Another overlooked pressure point is correlation. During stable periods, diversification appears effective. Assets move independently. Risk seems distributed. During adjustment, correlations rise, not because fundamentals converge, but because liquidity conditions dominate. When liquidity tightens, participants sell what they can, not what they want. This synchronizes behavior. Diversification fails when it is needed most. This realization often comes late, because correlations rise after pressure has already built. Another critical area is the behavior of market makers. Modern market making is optimized for low risk. Inventory is minimized. Positions are hedged. Exposure is temporary. This works well when markets are calm. But when volatility rises and funding costs increase, market makers step back, not out of fear, out of discipline. They widen spreads. They reduce size. They provide less depth. This reduces liquidity precisely when it is needed. Again, no panic is required. It is a rational response to change conditions. But the system depends on continuous liquidity provision. When that provision becomes conditional, markets become jumpy, small orders move prices, gaps appear, confidence erodes. Another area under pressure is passive flow dominance. Passive investing assumes continuous inflows. It assumes markets will absorb flows smoothly. It assumes trends persist. In stable environments, this is true. In adjustment environments, it becomes problematic. Passive flows amplify movement. They do not stabilize it. When prices rise, they buy. When prices fall, they sell. This creates momentum-driven markets. Momentum is dangerous during adjustment because it overshoots. Upside becomes stretched. Downside becomes abrupt. Markets that relied on passive stability become unstable. Another pressure point is the mismatch between funding horizons and asset duration. Many assets are long-term. Funding is often short-term. This mismatch is manageable when funding is cheap and predictable. It becomes dangerous when funding tightens. Rollovers become uncertain. Costs increase. Flexibility declines. This forces repricing, not because assets are worthless, but because they cannot be held comfortably. Another subtle pressure is behavioral. Years of stability trained participants to expect recovery. Every dip was bought. Every sell-off reversed. Every shock faded. This behavior is deeply ingrained. Adjustment breaks this pattern. Recoveries become weaker. Sell-offs last longer. Confidence erodes slowly. This confuses participants. They do not see a clear signal to exit. They do not see a clear reason to panic. So they wait. Waiting is not neutral. It increases exposure to structural pressure. This is how mistakes happen, not through reckless behavior, through delayed recognition. The key point is this: adjustment does not announce itself. It manifests as friction. Friction in funding, friction in liquidity, friction in pricing, friction in behavior. Each friction point alone seems manageable. Together they reshape the system. Markets are not breaking. They are being reshaped by constraints. And constraints always assert themselves, quietly, gradually, then suddenly. As pressure accumulates, the system begins to respond in ways that are not immediately visible. Not through collapse, not through panic, through behavior. Behavior changes before narratives do, before headlines do, before prices fully reflect it. The first behavioral shift is restraint. Participants become more selective. They hesitate where they previously acted automatically. They question trades that once felt obvious. This hesitation does not stop markets. It slows them. Liquidity becomes thinner. Depth disappears at the margins. Price discovery becomes uneven. This is when markets start to feel unstable without moving dramatically. Rallies lose follow-through. Sell-offs lack urgency. Everything feels tentative. This is not indecision. It is recalibration. Participants are reassessing assumptions they did not realize they were making. Assumptions about funding availability, assumptions about exit liquidity, assumptions about volatility behavior. When those assumptions weaken, behavior adjusts. Another consequence of sustained pressure is internalization of risk. For years, risk was externalized. It was transferred to policy, to liquidity providers, to intervention mechanisms. Now risk is being pushed back onto participants. This changes incentives. Hedging becomes more expensive. Leverage becomes less attractive. Exposure becomes more deliberate. This does not reduce risk immediately. It redistributes it. Risk moves from visible volatility into structural fragility. The system becomes more sensitive. Small changes have larger effects. Minor disruptions propagate further. Margins for error shrink. This sensitivity is often mistaken for instability. But it is not instability. It is brittleness. Brittle systems function normally until they don't. They tolerate little deviation. Another important shift occurs in time horizons. Participants shorten them. Long-term investments are reassessed. Projects are delayed. Commitments are postponed. This behavior is rational. When uncertainty increases and liquidity becomes conditional, flexibility becomes valuable. But widespread shortening of horizons has consequences. It reduces long-term investment. It suppresses growth. It increases dependence on short-term funding. This creates a feedback loop. Lower growth expectations reduce risk appetite. Reduced risk appetite tightens financial conditions. Tighter conditions suppress growth further. This loop does not require pessimism. It requires caution. Another area where behavior shifts is in risk concentration. During stable periods, concentration increases quietly. Capital flows into what works, into familiar strategies, into proven structures. Adjustment exposes the cost of that concentration. When pressure builds, concentrated positions unwind together, not because participants coordinate, but because constraints align. Funding costs rise for everyone. Liquidity conditions tighten for everyone. Risk limits trigger simultaneously. This synchronization amplifies movement. Markets begin to move not because of new information, but because many participants are responding to the same pressure. This is when price action becomes confusing. Moves appear disconnected from news. Reactions feel disproportionate. Confidence erodes. Another behavioral shift is the reevaluation of safety. Assets once considered safe are reassessed, not on fundamentals, but on liquidity characteristics. Safety becomes synonymous with liquidity. Assets that can be sold quickly retain value. Assets that cannot lose it. This is not a judgment on quality. It is a judgment on flexibility. This distinction matters because markets often price assets based on long-term value. Adjustment prices them based on short-term survivability. This repricing is uncomfortable. It challenges narratives. It contradicts valuation models, but it reflects reality under constraint. Another consequence of adjustment is the erosion of trust. Not trust in institutions, but trust in continuity. Participants stop assuming that tomorrow will look like yesterday. They become cautious with forecasts. They discount projections. They question models. This skepticism reduces participation. Less participation means less liquidity. Less liquidity increases volatility sensitivity. Volatility sensitivity reinforces caution. Again, a feedback loop. Another critical change occurs in credit behavior. Lenders become more selective. Terms tighten. Covenants return. This is often misinterpreted as stress. In reality, it is normalization. But normalization after prolonged accommodation feels abrupt. Borrowers who relied on easy refinancing struggle. Projects that depended on cheap capital stall. Defaults are not required for damage to occur. The mere Threat of tighter conditions alters behavior. Another overlooked effect is the strain on intermediaries. Banks, dealers, clearing institutions. These entities operate under regulatory and risk constraints. As volatility rises and asset values fluctuate, capital requirements increase. This reduces balance sheet capacity. Reduced capacity limits market making, limits credit extension, limits liquidity provision. This is structural. It does not respond to sentiment, it responds to rules. When rules bind, activity declines. This decline feeds back into markets. Prices become more volatile. Funding becomes more expensive. Confidence weakens. Another consequence is narrative lag. Narratives adapt slower than structure. Participants continue to discuss growth, recovery, opportunities, but behavior contradicts rhetoric. This disconnect creates confusion. People sense something is wrong, but cannot articulate it. They wait for confirmation, a signal, a headline. By the time confirmation arrives, adjustment is advanced. This is why adjustment phases feel sudden in hindsight, not because they were sudden, but because recognition lagged reality. The most dangerous aspect of this phase is complacency, not because people are reckless, but because the environment does not feel urgent. No collapse, no panic, no obvious trigger. So exposure remains, risk accumulates, fragility increases, adjustment continues, quietly, mechanically, inevitably. The system is not failing, it is shedding assumptions, and systems always resist that process until they cannot. As adjustment deepens, the system begins to reveal its weakest points, not all at once, not evenly. Pressure finds leverage. The first place it concentrates is where flexibility is lowest. Highly leveraged structures, assets dependent on continuous funding, strategies that assume stable correlations. These areas do not fail immediately. They bend. Positions are trimmed. Risk is reduced incrementally. Exposure is adjusted quietly. This creates the illusion that the system is adapting smoothly. But smooth adaptation requires slack, and slack is limited. As pressure persists, incremental adjustments become insufficient. Margins tighten. Funding terms worsen. Liquidity buffers shrink. At this stage, the system becomes reactive rather than adaptive. Participants respond to conditions rather than anticipating them. This is a critical shift. Reactive systems amplify shocks. Adaptive systems absorb them. Another important change occurs in price behavior. Markets become more discontinuous. Moves happen in bursts. Liquidity gaps appear. Prices jump rather than glide. This is not volatility driven by fear. It is volatility driven by absence. Absence of bids, absence of depth, absence of willingness to commit capital. When markets are well supported, price discovery is smooth. When support thins, price moves violently through empty space. This is why small events start to matter, not because they are significant, but because the system cannot absorb them. A minor data surprise, a routine policy comment, a modest earnings miss. Under normal conditions, these would be ignored. Under constraint, they become catalysts. Another effect of adjustment is the breakdown of diversification. Assets that once moved independently begin to move together. This is not correlation caused by panic. It is correlation caused by liquidity. When liquidity tightens, participants sell what they can, not what they want. This creates forced alignment. Risk spreads across markets that appear unrelated. Equities respond to rate moves. Rates respond to funding stress. Funding stress responds to volatility. Everything becomes connected. This is often misinterpreted as contagion. In reality, it is structure asserting itself. Another pressure point is duration. Assets with long cash flow horizons become more sensitive. Higher discount rates reduce present. Value. Uncertainty increases required returns. Patience disappears. Long-duration assets underperform, not because fundamentals changed, but because time became expensive. This repricing is mechanical. It does not wait for recession. It does not require default. It reflects changed conditions. Another critical shift is in behavior of risk managers. Limits are enforced more strictly. Exceptions are removed. Flexibility disappears. This is rational. Risk managers respond to volatility, drawdowns, and funding stress. They are paid to reduce exposure when uncertainty rises. But when many risk managers act simultaneously, markets move sharply. This behavior is synchronized, not coordinated, not emotional, structural. Another consequence of sustained adjustment is the erosion of carry. Carry strategies depend on stability, on low volatility, on predictable funding. As volatility rises and funding tightens, carry becomes fragile. Positions unwind. This unwinding is mechanical, rules-based, often automated. It accelerates movement. Another overlooked effect is the role of passive flows. During stable periods, passive investing dampens volatility. Flows are steady, rebalancing is predictable. Under adjustment, passive flows become amplifiers. When prices fall, outflows increase. When prices rise, inflows slow. This creates asymmetry. Upside becomes muted. Downside accelerates. This is not sentiment. It is structure. Another pressure point is collateral valuation. As asset prices fluctuate, collateral values change, haircuts increase, margin requirements rise. This forces deleveraging. Deleveraging reduces liquidity. Reduced liquidity increases volatility. Increased volatility forces further deleveraging. This loop is powerful. It does not require fear. It requires arithmetic. Another important effect is the deterioration of market making. Dealers reduce inventory. They widen spreads. They provide less immediacy. This is rational. Market making consumes capital. Capital becomes expensive under stress. Reduced market making increases price impact. Price impact increases volatility. Volatility further discourages market making. Again, a feedback loop. At this stage, markets begin to feel unstable, not because of a crash, but because of unpredictability. Moves feel sharper. Reversals are violent. Liquidity appears and disappears without warning. Participants become cautious. Caution reduces activity. Reduced activity reduces liquidity. Reduced liquidity increases instability. The system enters a fragile equilibrium, functioning but sensitive. This is the phase where observers ask the wrong question. They ask, why hasn't it broken yet? The correct question is, how much pressure can it still absorb? Because the system is no longer building resilience. It is consuming it. Each adjustment uses capacity. Each shock reduces tolerance. Each intervention has diminishing effect. At some point, adjustment transitions into repricing, not because something new happens, but because accumulated pressure exceeds tolerance. When that happens, movement accelerates, not gradually, not smoothly, abruptly, not because of panic, but because the system no longer has buffers. This is how forced adjustment ends, not with warning, not with consensus, but with realization that the system has already changed and prices must follow. When adjustment finally reaches its limit, the outcome feels sudden, not because it was unpredictable, but because recognition lagged reality. For a long time, the system functioned under stress. Pressure accumulated quietly. Behavior adjusted incrementally. Nothing appeared broken. Then one day, pricing shifts decisively. Liquidity does not vanish all at once. It steps away, participation declines, risk tolerance collapses, depth disappears. Prices move not because sellers panic, but because buyers are absent. This is the defining feature of late-stage adjustment. Markets do not fail from excess fear. They fail from insufficient support. By the time this becomes visible, the process is already advanced. Observers look for the trigger, a headline, a data point, an event, but the event is incidental. What matters is that tolerance was exhausted. The system could no longer carry the weight placed upon it. This is why post-adjustment explanations often feel unsatisfying. Analysts argue about causes. They debate narratives. They search for blame. But structure does not care about narrative. It responds to constraints. The constraints were tightening for months, sometimes for years. Funding became selective. Leverage became fragile. Assumptions stopped holding. The final move only revealed what was already true. After repricing, behavior finally changes. Exposure is reduced decisively. Risk is repriced honestly. Leverage is removed forcefully. This feels violent, but it is corrective. The system sheds what it can no longer sustain. Importantly, this phase is not collapse. Collapse implies failure. This is adjustment completing. The difference matters. Collapsed systems cannot recover without external reset. Adjusted systems can stabilize once structure realigns. After repricing, markets feel different, not calmer, clearer. Volatility remains elevated. Liquidity remains cautious. But behavior becomes consistent with conditions. Assumptions reset. Participants stop expecting protection. They stop assuming stability. They price risk explicitly. This is when resilience slowly returns, not because conditions improved, but because behavior aligned with reality. This is why the most dangerous period is not after repricing. It is before it, when pressure is building, when adjustment is incomplete, when assumptions persist despite changing structure. During that phase, mistakes are easy to make. Exposure feels justified. Patience feels rewarded. Risk feels manageable. Until it isn't. Once repricing occurs, mistakes become harder. Risk is visible. Costs are clear. Decisions become deliberate. The system regains balance through constraint, not comfort. This cycle is not unique. It repeats across history, across asset classes, across systems. Only the details change. The pattern remains. Stability encourages optimization. Optimization removes redundancy. Redundancy loss creates fragility. Fragility requires adjustment. Adjustment resists until it cannot. Then repricing restores alignment. This is not pessimism. It is structure. Understanding this reframes how markets should be viewed, not as fragile entities waiting to break, but as adaptive systems responding to constraint. Breakdowns are not failures. They are signals, signals that assumptions outpace capacity. Those who understand this do not try to predict the moment. They observe the structure. They watch liquidity. They watch leverage. They watch behavior. They understand that when systems adjust quietly, outcomes feel sudden, not because the future changed overnight, but because recognition finally caught up. This is the reality of late cycle environments. Not panic, not headlines, not fear, pressure. And pressure always resolves, one way or another.